the US-China trade tensions have grown to become a defining issue in global economics. Over the past few decades, trade relations between the two largest economies in the world have been marked by shifting dynamics, evolving policies, and increasing confrontations. Initially, the US and China experienced rapid growth in bilateral trade, with China becoming a major manufacturing hub and the US a key consumer of Chinese goods. However, as China's economic power grew, so did concerns in the US about trade imbalances, intellectual property theft, and the erosion of domestic industries. The roots of the conflict can be traced back to the early 21st century, as China's economic rise began to challenge the global balance of power. The US, once the undisputed leader of the global economy, found itself confronting an increasingly assertive China. This rivalry was further intensified under the leadership of President Donald Trump, whose "America First" policy led to the imposition of tariffs on Chinese goods, marking the start of an ongoing trade war. Meanwhile, China's President Xi Jinping pursued aggressive economic reforms, aiming to secure China's place as a global leader in technology, manufacturing, and trade. These tensions have not only reshaped the trade policies of both nations but have also had significant implications for the global market. As trade disputes continue to evolve, businesses, investors, and policymakers around the world must navigate the shifting landscape of tariffs, regulations, and diplomatic negotiations. The outcome of these tensions will have far-reaching consequences for global trade, influencing everything from supply chains and investment flows to geopolitical relations. As we explore the deeper effects of these tensions, it becomes clear that understanding the historical context and key players involved is essential for grasping the broader implications for international trade. The next section will examine the underlying causes driving these trade disputes and the strategic responses from both the US and China. The escalating trade tensions between the US and China are primarily driven by three key factors: tariffs, intellectual property theft allegations, and geopolitical rivalry. Each of these elements plays a significant role in the ongoing conflict between the two superpowers, influencing both their domestic policies and the broader global economy. One of the most visible manifestations of this trade war is the imposition of tariffs. In 2018, the US, under President Donald Trump, introduced tariffs on over $200 billion worth of Chinese goods, accusing China of unfair trade practices and intellectual property theft. These tariffs were intended to pressure China into addressing trade imbalances and to protect American jobs and industries, particularly in manufacturing and technology. In response, China retaliated with its own set of tariffs on American goods, further escalating the dispute. This tit-for-tat exchange of tariffs has disrupted global supply chains, raised prices for consumers, and caused uncertainty in the international market. The impact of tariffs goes beyond the immediate financial cost. They represent a shift in the global economic order, where the traditional flow of goods and services is being questioned. Intellectual property theft is another central issue in the US-China trade conflict. The US has long accused China of engaging in widespread intellectual property theft, particularly in sectors like technology and pharmaceuticals. Companies in industries such as software, telecommunications, and electronics have claimed that their intellectual property is being copied and used without compensation. These allegations have intensified as China has rapidly expanded its technological capabilities, particularly in areas like artificial intelligence, 5G networks, and advanced manufacturing. The US has demanded that China implement stronger protections for intellectual property, fearing that the lack of enforcement undermines American innovation and global competitiveness. These disputes are not only a matter of economic loss but are also perceived as a challenge to the global structure of intellectual property rights, which impacts industries worldwide. Geopolitical rivalry also fuels the trade tensions between the two nations. As China's influence on the global stage has grown, the US has increasingly viewed it as a strategic competitor. This rivalry extends beyond trade to encompass military, diplomatic, and technological domains. The US has sought to counter China's rise, particularly in the Indo-Pacific region, where China's Belt and Road Initiative and growing military presence challenge US interests. This geopolitical competition further complicates the trade relationship, as each country seeks to protect its strategic advantages while using economic tools, such as tariffs and trade agreements, to gain leverage. The expansion of China's influence through infrastructure projects and investments in developing countries has alarmed the US, which fears that China's growing control over global supply chains and strategic choke points could undermine American geopolitical dominance. The impact of these three factors, tariffs, intellectual property theft, and geopolitical rivalry, has been profound, not only for the US and China but for the global economy. The uncertainty surrounding trade policies has caused disruptions in global supply chains, shifting production patterns, and leading to an overall slowdown in global trade growth. For instance, industries in both countries have faced substantial delays and cost increases as manufacturers are forced to rethink their supply chain strategies, while countries that are caught between the two powers are forced to make difficult choices about their alliances. Additionally, countries around the world have been forced to navigate the evolving trade landscape, adjusting their own policies to mitigate the effects of the US-China trade war. The effects of these tensions are not confined to the economies of the US and China alone. They ripple out to global markets, affecting everything from commodity prices to stock market fluctuations. The trade war has led to a re-evaluation of global dependencies, with countries reconsidering their trade strategies and alliances. Companies have increasingly sought to diversify their supply chains, either by relocating production to other countries or reshoring operations back to their home countries. As the US and China continue their economic and geopolitical jockeying, it is clear that the ripple effects of these tensions will be felt around the world, reshaping global trade patterns for years to come. As we delve deeper into the consequences of these tensions, it becomes clear that the resolution of these issues will not only impact US-China relations but will also shape the future of global trade and geopolitical dynamics. The next section will examine how these trade tensions are playing out in the global market, with particular focus on key sectors such as technology and agriculture. The ongoing trade tensions between the United States and China have had profound implications for global markets, with ripple effects across various industries and sectors. These tensions have influenced not just bilateral trade but have also disrupted broader international trade dynamics, affecting markets from technology to agriculture. As both nations have navigated the complexities of their economic relationship, the implications for global supply chains, investment flows, and economic growth have become increasingly significant. Understanding how these trade tensions have impacted different global markets provides insight into the long-term consequences of the US-China conflict. One of the most significant areas affected by these tensions is the global technology market. Technology is a core industry for both the US and China, and the trade war has intensified competition and created new barriers for companies in both countries. The US has accused China of unfair practices in technology transfer, particularly in industries like telecommunications and electronics, which has led to a series of export bans and restrictions. Companies like Huawei, one of China's leading tech firms, have been directly impacted by these policies, which have barred them from using key US-made technology, including semiconductors. As a result, not only has this hindered China's technological advancement, but it has also disrupted global supply chains reliant on Chinese manufacturing and American technology. The global technology market has had to adapt to the changes brought about by these tensions, with some companies opting to diversify their supply chains. For example, several US-based tech companies have started shifting production outside of China, seeking alternatives in other Asian countries like Vietnam and India. This shift aims to mitigate the risks of tariffs and the possibility of additional restrictions that may further disrupt business operations. At the same time, Chinese tech companies have begun to increase their investments in domestic innovation, attempting to reduce their dependency on foreign technology. This has spurred significant growth in sectors such as artificial intelligence and 5G development within China, but also raised concerns globally about the potential for new forms of technological nationalism. In addition to the impact on technology, the global manufacturing sector has faced significant disruptions due to the trade war. Both countries' policies have caused a reorganization of supply chains that has resulted in increased costs for manufacturers and reduced profit margins. For example, tariffs on Chinese-made goods have raised prices for many US manufacturers who rely on Chinese parts and components. This has forced companies to either absorb the additional costs or pass them on to consumers. The global manufacturing landscape has been reshaped as companies are pressured to source materials from alternative regions, creating new complexities in terms of logistics, quality control, and pricing. This restructuring of global supply chains has led to inefficiencies and delays, further exacerbating the already slow global economic recovery following the COVID-19 pandemic. The shift in manufacturing has also had a profound impact on global labor markets. With the disruption of traditional supply chains, many jobs in industries such as electronics, automotive, and textiles have been affected. While some jobs have moved to other countries, the overall trend has been a loss of manufacturing positions in both China and the US. This transition is particularly evident in the US, where manufacturers have struggled to find domestic alternatives to replace Chinese imports. In the short term, this has led to job losses in certain sectors, while in the long term, it has forced industries to adopt new technologies and automation practices to remain competitive. The restructuring of these supply chains has also prompted companies to reconsider the strategic importance of maintaining a presence in low-cost manufacturing countries. Agriculture is another sector that has been significantly impacted by the US-China trade tensions. Both nations are key players in global agricultural trade, and the imposition of tariffs has disrupted traditional trade flows. China, for example, has imposed tariffs on American agricultural products such as soybeans, pork, and cotton, significantly affecting U.S. farmers who rely heavily on exports to China. In response, U.S. farmers have sought new markets in regions like Europe and Southeast Asia, but these markets are not able to absorb the volume of exports that were previously directed to China. This disruption has created a surplus of certain agricultural products, driving prices down and putting pressure on farmers' profitability. In contrast, China's agricultural sector has also faced difficulties as a result of the tariffs, leading to supply shortages and price increases for consumers within China. Long-term, these disruptions in the agricultural sector could reshape global food security and trade patterns. The uncertainty surrounding the US-China agricultural trade has prompted countries to rethink their food security strategies and explore new trade partnerships. For example, Brazil and Argentina, major agricultural producers, have seen increased demand for their products as China seeks alternatives to American imports. However, these changes come at a cost, as countries that were previously reliant on cheap imports are now facing higher prices and supply chain uncertainties. As the US-China trade tensions continue to unfold, the broader economic impact is becoming increasingly evident. The long-term effects on global supply chains, investment patterns, and economic growth are still unfolding, and it is likely that the world will see a more fragmented global economy in the years ahead. While both countries have expressed intentions to reach a trade agreement, the fundamental issues driving these tensions, such as intellectual property theft, market access, and geopolitical rivalry, remain unresolved. The global economy, already struggling with the aftermath of the pandemic, will likely face continued volatility as nations adjust to the shifting dynamics of global trade. The road ahead for global markets is uncertain, but one thing is clear: the repercussions of the US-China trade war will resonate for years to come, shaping the future of technology, manufacturing, agriculture, and international trade. The next section will examine potential strategies that countries and businesses might employ to navigate the ongoing trade war and position themselves for success in the evolving global market. The trade war between the United States and China has evolved into a complex economic and diplomatic conflict, with both nations employing strategic responses to manage the fallout and protect their economic interests. The United States has largely relied on tariffs, trade deals, and diplomatic negotiations as key components of its strategy. Through the imposition of tariffs, particularly during the tenure of President Donald Trump, the U.S. aimed to pressure China into addressing trade imbalances and intellectual property theft issues. Tariffs were placed on hundreds of billions of dollars worth of Chinese goods, which in turn provoked retaliatory tariffs from China on U.S. products, further escalating the tensions. In addition to tariffs, the U.S. has pursued trade deals as a means to mitigate the impact of the trade war. A key example is the US-Mexico-Canada Agreement, USMCA, which replaced the North American Free Trade Agreement.